A very good morning to you, traders. Welcome to the new week. Thank you for coming to the Flow Show. Good morning, K-Man.
Good morning, Ryan. Good morning, everybody. Welcome to October.
Yeah, October. God, nearly a year gone through already. Time flies when you're having fun, eh?
Yeah, having fun, yeah. No, but yeah.
That's one way to describe it, I suppose.
Time flies.
Be Christmas soon, and then we'll be moaning again that it's cold and wet and dreary.
Yeah,
yeah, I hope you folks all had a good weekend. Few bits and pieces out over the weekend to go through and from last week. Let's do that first, I think, get over the data that we saw last week. So probably the big data on Friday was obviously the PCE numbers, pretty much following the CPI report in the headline number just coming down a touch to 6.2% from 6.4, but the core going the other way, up to 4.9 from 4.7. As I say, similar to what we saw in the CPI numbers previously, where the headline came down and the core went up. The core tends to lag the headline number, but in this case, it's going to be to see whether we actually see the headline starting to pick up again, or whether we have got signs of a top in inflation there, but we see the core ticking up for maybe a couple more months before then pulling back. There's lots of things in the pipe to suggest that prices may have peaked, or at least be moderating a bit. You know, we know oil prices are down. We know, particularly in the US, nat gas prices are down. A lot of the stuff that spiked last year, things like lumber, that sort of thing, have also come down. So really, if you recognize what inflation is when we look at the year-on-year numbers, it's what it is versus the year before. So if prices are up 7, 6, 7, 8% this year, they've got to go some to be up higher than that in the next year. So that's why you tend to get this accounting trick where inflation really has to rocket to get it up year on year for the next year. So there's every chance that we start to see inflation numbers, as I say, at least moderating, perhaps coming back down. I still think there's a few months more to see some of the older stuff coming through, because a drop in oil yesterday doesn't come through to inflation that quickly. It's usually maybe 3 to 6 months before you really start seeing the effects of prior price moves. But anyway, the PCE following the CPI, as we say there, something for the Fed to get their teeth into. Now, as far as that data and Fed rate expectations, it did lift the expectations slightly from 61% to 68% for a 75 pip hike. Today, running around there or thereabouts, a 75 pip hike currently is probability of 63%. The other side is the 50 basis point hike is obviously at 37%. So there's no 100 basis point pricing at all now, following the last FOMC. 100 pips, I think, are well off the table now. So the market is going to be swinging between this 75s and 50s for the foreseeable future. A 75 pip hike takes the rate up to the 3.75, 4% mark. So there's still potentially room for further hikes of that magnitude into the end of the year. But when we get to 4%, the market's probably going to ask a lot of questions on how much further the Fed are going to go. As we've been speaking about last week, there's going to be a lot of ruminating about where rates are for a lot of the central banks into the end of the year. Now, there was a piece out from Fox reporter Charles Gasparino late on Friday. He said, according to some Fed watchers, the Fed are becoming increasingly concerned with the systemic risk to the financial system over rising rates. This has probably been sparked with what's happened in the UK and everything to do with bond yields rising and the effect that's had on some aspects of the market, the pension situation. I'm not going to talk about the government stuff to do with that, because I don't believe that's a whole part of it. It's just a small part of it. But, you know, really the US hasn't seen any real impact from rising rates. And, you know, they've gone up pretty much in a straight line. And this is going to be something we need to be careful of if the Fed starts seeing some financial stability worries from rate hikes, because that's one thing that will cause them to pause. And they haven't seen anything yet. They've not seen any real negative effects from rate hikes. Maybe some creaks in the market, as we've been showing over the last few months. And I'm fearful that because they've seen no effects and rates have jumped so high so fast, when they do see problems, they're going to come thick and fast as well. It's going to be a bit of a car crash, if you like, rather than something that's slow and steady. So be careful of that. I won't call it a source's story, but they're called Fed watchers in his terms, saying that the Fed are becoming concerned with that. Over to the UK, we've got UK's Truss and Kwarteng, the chance of reversing this 45p top rate tax cut. Well, I won't call it a cut. They were going to cut to 40p. They're now not going to cut to full 40p. They're going to keep it at 45p. So everything's unchanged there. It is a bit of a reversal from the UK, and that's obviously being picked up in the press. That caused the quid to jump quite significantly this morning, up near 138, but 113 on that headline there, but that didn't last long and we're back down. The pound is still very volatile and very jumpy. Now, there was also a note that an MP has put in a letter of no confidence. One MP has put a letter of no confidence in on Truss. As you may recall, it takes a certain amount of letters to trigger a no confidence vote. That's what happens, boys. So one MP has already put in a letter 5 minutes after she's become Prime Minister. Now, it's worth remembering that Rishi Sunak was the choice of a lot of MPs, not Liz Truss. Liz Truss was chosen by the Conservative membership, so all the people who are a member of the Conservative Party, not by the MPs per se. You may recall Sunak was my favourite to take over, and he would have been more market friendly and more business friendly than Liz Truss, and perhaps we're bearing some of that coming out in the pound and UK assets as we speak. But one letter of no confidence vote has gone in. Not a big deal at the moment. If they start flooding in, then we've got something on our hands, and that potentially might lead to calls for an early general election, because there'll be two prime ministers in a short space of time under pressure from their own party, and the opposition will be all over that. Going over to the Bank of England, they did their gilt operation again on Friday, just under 1.2 billion done versus 1.4 billion the day before, so on Thursday. So again, not getting close to their 5 billion limit that they're putting in daily on that. So things potentially easing in that situation as well. China is shut this week. It's also the month, we enter the month of October, where we're getting towards the their People's National Congress, the big party meeting where they all say how great things are in China. We've already heard that banks have been told to potentially buy shares. Banks have also been told not to sell shares. We've heard about banks being told what to do with the yuan. So there is still the potential for a lot of support coming into the market. I read a story in the FT this morning saying that China's policies, easing policies, have helped property shares rally. I don't know if it's that or if the fact that loads of their banks are artificially trying to inflate stocks into this People's Congress. But that's the sort of thing we're going to be facing. They may be on holiday, they will still be keeping an eye on the markets. Over to Japan, and we'll look at some of the data, but there was some survey data out amongst, amongst Japanese firms on inflation, and they see 1 year inflation at 2.6%, 3 year inflation at 2.1%, and for the first time in a long time, 5 year inflation touching the magical 2% mark. That's got a bit of fanfare around markets because it's showing inflation expectations rising in Japan. We've seen that. We've had the data, inflation data going up in Japan as well. So we've seen all that coming into the market, and now we've got firms thinking higher inflation as well. So it's all feeding into the Bank of Japan rhetoric. As you can see there, we've got a bit of data out. Not too good on some of the data from large manufacturers. Seeing some numbers there in the outlook numbers, things like that, and they do different sizes there. So that's bucking a bit of a trend that we've seen in other data, where we've seen improvements across the board. So maybe a bit of softness coming in there in these diffusion indexes in manufacturing. Kay, you got anything you want to add on the well, anything from Friday and over the weekend you want to pick up? I know the fixings were a bit choppy on Friday.
The fixings were lively, as we have seen on Wednesday, Thursday as well. So it does appear that the way it's trading right now, that we have done a few, I wouldn't call them extremes, they are not extremes, but let's call the moves a bit violent into end of month. We saw a lot of euro crosses buying, we saw a lot of sterling buying, which was expected by about half of the models. The other models, they've been thrown in the bin. So yeah, and now we're seeing a bit of a reversal of all that. Looks like we are going to perhaps settle in a bit of ranges. But apart from that, I didn't really see much else than what you have been reporting so far. There's been a bit of noise going on around Germany's 200 billion borrowing plan to curb the crisis for households and energy woes and things, and that other countries in Europe are a bit jealous, I would say, because they can't spend this kind of money. So on the fiscal side, it's not all rosy in Europe either. But for the rest, I didn't see too much big stuff coming out. There's these rumors about the OPEC going on that started end of last week as well, went on over the weekend, that they could cut output by even more than 1 million barrels per day, even though some of the countries are already underperforming or under their quota of output. Some are a little bit above. Perhaps they can rebalance a bit of that. And oil got a bit of a jump this morning on the back of it, coming out of the weekend. Apart from that, I haven't seen really much going on. And we're starting October. I think the underlying we're going to have to watch a few things. Of course, we have to watch growth. We have to watch the CPI expectations as well, of course. But I think growth will play for a lot now. We've seen that big rejection as well at the end of the month in the yields, especially the $10s and 30s a bit less. Well, still they moved a lot, but people are focusing on the $10s and that famous or infamous 4% mark, which is big, whether it be technical or psychological. And we've seen a big rejection out there. Now we have to monitor what the US wants to do with it when they start their new month. Are we going to get back there? We can't forget though that besides everything that's going on in yields, QT is still there, and it's still tightening financial conditions under the surface. So we have to bear that in mind, regardless what yields are doing.
Yeah, definitely, mate. Definitely. Just back to the OPEC stuff. I think we're up to 1.5 million now. The rumor of potential cuts over there. It started off at 1 million barrels a day. Now it's up to 1.5 million barrels a day. As is usual, going into a OPEC plus OPEC meeting, we get 100 million sources coming out, 100 million different numbers of expected stuff to come out, and then we'll see what market will flip around. Then we'll see what happens at the actual meeting and what's decided. Just a couple of other things. Credit Suisse is in the news. There was some rumours out over the weekend about a bank in trouble, and Credit Suisse has been put in the frame. That's not really new news. They've been in the frame for this sort of thing for quite some time now, but they've taken a bit of battering in stocks and in their bonds and that sort of thing. So The CEO was out trying to calm markets over the weekend, saying that there's no issues, but it looks like he needs to do more on that because they've been absolutely battered this morning. One thing that someone popped up on Twitter was to keep an eye on potentially on the S&B if they increase some reverse repos with someone like the US for dollars. A bit of a link being put on that if Credit Suisse is in trouble, and if the S&B or the Swiss government have to step in, they might need to do some swaps there just to get some short-term liquidity into the market. So if anything happens there, just keep an eye on that in case the market links it to the Credit Suisse stuff. Also, this weekend, there's been some rumours about an emergency Fed meeting today. Now, this is something that crops up now and again from people who don't know any different. The Fed hold some closed meetings all through the month. And one of those meetings each month is to discuss the discount rate. Now, these meetings are done under what's called expedited procedures, which makes it sound like it's all, special meetings and all something we should all pay attention to, but it's not. But someone yesterday, I think, started up the news that there's an emergency meeting, but it's not. It's one of the regular meetings. So it's all scheduled, so really nothing to see there. But if you see that floating around the market, you know what it is. Those in the chat room, our chat room would have seen that across the main pages and in the newsroom. Right, so just looking at some of the, yes, mate.
I mean, excuse me, but maybe my English that sucks. But when they say expedite, doesn't that in English mean that they are just doing it on a quick? They're just doing it quickly, and it's actually nothing really special.
Yeah, they use expedite. It's under expedited procedure, which is due to I think
it's just a fast procedure, right?
It's meant to. It sounds like a fast procedure, but it's not, because they do it every month. I think they started this, I think a couple of years ago. To do with QE and all their policies. So these discussions on the discount rate is done under this expedited procedure, but they've made it a regular monthly thing for about 2-3 years. So it sounds like it's something that's they've just decided, and let's do this meeting quickly, but actually it's not. And as I say, the link is in our newsroom. If I can find it before the end of the show, I'll pop it in the chat room here. You can all have a look at it.
Personally, I don't think anything special about this meeting.
No, it's not. That's the point. Some people are saying it's an emergency Fed meeting, and it's not. It's a regular meeting. No, not at all. So yeah, that's the sort of point I was trying to make there. Right, so yeah, just looking at the other data we've had this morning, it's been manufacturing PMI finals. Depending on where you look, they've been a bit up and down. Spain coming in a bit softer. That's a fresh reading there, down to 49 from 49.9. Italy was a bit better than expected and prior. France, minor change there. Germany looking worse there. Into some of the others, Eurozone, the pan-Eurozone number down. UK smaller down than expected. So we've got all this stuff coming out today. We've got the ISM, and it's ISM week, so we're going to get the manufacturing today, services later in the week. It's obviously jobs week as well. We've got JOLTS coming out, although that's lagging by a couple of months. We've got NFP on Friday, ADP on Wednesday, NFP on Friday, also Canadian jobs on Friday as well, and a couple of retail sales reports coming out. So a fairly big week for data this week, to keep an eye on that. Right, well, let's get into some of the prices then, shall we?
I did put the link in the chat about the Fed.
Yeah, lovely. Thanks a lot, mate. Right. Cheers. Yeah. So if you click that link, you'll see that there's a whole list of meetings there previously. Right. So a little bit of a break going on in dollar yen and this 145 level. As I've been suspecting last week, I think a lot of people were parked into that, trying to pick a level for the Bank of Japan Ministry of Finance. Any reason for this driver through 145k? You know, it's just,
no,
I
it's
mean,
been
the lowest volatile.
it's happened overnight already. Dollar picking up a little bit. I think the market is just attaching this 145 as psychological, but where the MOF intervened wasn't even 145. It was above that when they started to check. The thing is, it's a tech level 144.90, 145 the figure. We're back through despite yields not picking up, but I think the market is just was on hold for the end of the month, end of quarter, end of semi-fiscal year in Japan, and now the dollar seems to start to pick up a little bit again. We're undoing the end of the, partially at least, undoing the end of the month, end of quarter moves. I don't. This to me it was pretty interesting that dollar yen is holding 143.90 figure after the interventions, and then the let's say rebalancing of the interventions, quieting down of the interventions. We couldn't get sub 143.90 figure anymore, and that to me is now my first big marker on the dollar yen. If we get back down there and we hold down below, there might be something changing for the more, I wouldn't say long term, but for the more a bit medium term, more than just the day-to-day trading. But as long as that holds, I think we're still in a very, very large monetary policy divergence, and the Japanese government is still putting in stimulus packages, and to me, I still can't be long yen unless we start to really go down and hold lower levels in the dollar yen.
Yeah, I agree. You know, it's easy to get sucked into maybe sometimes a shorter term moves, you know, looking at a 15-minute chart, an hourly chart, and something. But you know, if you come out to something like a daily, you can see, you know, that trend looks firmly in place. Unless we get a decent refresh correction, like we've seen a couple of times, you know, when we hit the 140s and then drop back again, you know, good refreshes of the trend. Up here, we're just doing similar. You know, if we do get a move on, this trend continues, as long as it's not volatile, as long as we're not jumping 200-300 pips in a session, this thing could grind all the way up to 150 and even more. We've had comments out overnight from Suzuki. It's the same old record. Really, nothing new from him at all. And yeah, my real fear was that a lot of people put stock in the 145 level as a Bank of, let's just call it a Bank of Japan level. And that's not been the case. As Kay mentioned, they didn't intervene until we were up near 146. So perhaps that is also going to be another marker for those thinking that maybe the Bank of Japan are going to step in on behalf of the MOF up at 146. So keep an eye on that. It's likely we could see some big figure tennis if we get up there, and then we find that 145 is becoming support. Now, my overall view coming into this week, the US data, everything that's going on, as far as Fed rates go, we know the path they're on. We know the high bounds they've set. It's going to take a lot, in my opinion, for the market to take another hawkish leg up on the Fed, because they know where the Fed are now. So rates may begin to 4.5%, 5%. That's quite high. You know, where do we go from here to become more hawkish? That would mean rates going up to 5%, 6%, but that would mean the data really being good, inflation continuing to rise. And if that doesn't happen, I find it very hard to see, at least from the Fed side, the dollar gaining significantly from here. Now, it could still gain because of what happens everywhere else, i.e. what happens in Japan, what happens in Europe, what happens in the UK, etc. But for now, I'm still in the camp that I think we're going to see, at the very least, some consolidation in the dollar. If not, we see it starting to head lower, on the basis that the Fed have got to do a hell of a lot more to bring revised expectations higher. So for dollar yen, you know, at the moment that 146 is going to be quite key. But then we're going to be going back to, you know, some real longer term levels. 137.35 is the big fib, you know, this massive move here, you know, all the way back into the 80s to there. So, you know, the 50 fib of that is at 169. So some big key levels. We're going to be going back to some old areas to look at where we potentially have some resistance further up. You know, we've got that area, as you can just see in there, you know, back to 1998, previous highs up there. These are the sort of long-term technical areas we're going to be looking at if we continue to truck up. But we'll keep an eye on that. It's I doubt it's going to go up in a straight line. Another pair I want to just show you quickly, and then I'll let Kay do his little round robin. Where are we? Let's go into this 15-minute. So euro sterling been on its little holiday jaunt up to the 90s and all the way back down again, purely on the volatility that's gone on in the quid. So now I think we're getting back to maybe reflecting the fundamentals properly, all the way back to where we were before that happened. Looks like we've got an important test and hold of this bit of a zone, 86.90, 87, 15.20, we can call it. This was the prior break point where we knocked our head for quite a while. I'll just show you that more clearly. There, that should do it. So this 87 level, you know, we've been watching a long time this year. Banged our head on it several times, got the break, held the break, had all this move. Now we're down, holding the break point as well. So I missed this morning, but it's looking like it could be a key level here. If we get under there, then we're potentially going back in the maybe the 86, 85 box. So keep an eye on that one there. That's one I'm looking at. I missed it this morning, but I may have a little look a little long if we get down to that 87 handle. I'll be worried that we've come back so quickly after the first test, but it's just technically it's looking a good level. Kay, do you want to take your bits and pieces?
Yeah, sure.
For a few minutes.
Yeah, sure. What am I going to do first? I'm going to go back onto the dollar yen since you spoke about it.
Yeah, go ahead, mate.
Because I have a slightly different view on it right now, and I must say I'm still I may be a bit stubborn here, but I still can't buy yen for one and sell dollars for two, because of this underlying tightening, which is caused by quantitative tightening. So whatever the yields move higher or not, we still have this tightening, and it's still going to affect other countries' dollar debt in some stage, because at some stage, because the you can talk about yields, and but then you talk about what's available. So we could still have a mechanical drive up even without the Fed getting more hawkish. We could still have a mechanical drive up because the punch bowl is getting a little bit smaller every month. So I'm not yet in the camp where the dollar needs a continued hawkish Fed to advance. Yes, there will be some effects, but I'm not yet in that camp right here and now. So on this dollar yen, yeah, as Ryan was showing, the 147.80 is where Mr. Yen in those days, Sakakibara, intervened, and they did put it down to certain levels. So actually, let me try to zoom in on this one. Oh, sorry, that's a mistake. So the actual interventions were here. That was the MOF intervention, and then we went all the way back up. They intervened again, and then here, what happened here is that's not interventions of the MOF. That's the Asian financial crisis that we saw in October 1998, where dollar yen lost 22, 23 big figures in 2 sessions without even interventions. And actually what happened here in October is that they actually intervened to try and prop the dollar yen up again already. That was more of a joint intervention then. But yeah, the market is talking a lot about this level. So if the market talks about it, we should as well. That's just a rule. Some small rule of trading. I won't call it a rule, but something that I'm watching on. If we can try to be clever and trade things that nobody talks about, and we can find good fundamental reasons to trade those things. But if nobody talks about it, if nobody looks at it, we are going to feel a little bit lonely in the positions that we can have. So now the market is talking a lot about this level. So I think it's going to be looked at, especially that it's an extension as well of the, and there I have to go back on to the daily, I think. It is, and why don't I have this? Because it's an extension of the 139. Let me try to put that one back on. It's an extension as well of the 139, 130. Anyway, it comes in at around 147.38, I think. So it is going to be a bit of an important level. We also can see that if you look at the latest uptrend channel, it's also around there. Okay, it's going to go creeping higher. This lies around 148, but we can see here that this 147, 148 is going to be important if ever we get up there. And seeing the tightening of financial conditions, unless oils, commodities come off, because Japan is a big importer, unless that comes off and yen starts to strengthen naturally, it is going to be an important zone where we could actually target. So that's my idea. For as long as on the short term we hold above this 143.90 figure where we have been holding in the last couple of attempts, then I have an interesting one which I was looking at because actually I was looking at it because before Putin actually came out and annexed those 4 regions in Ukraine. Look at this 142.5 on the euro yen. It's been quite a zone of traffic. Call it anywhere between 142.40 to 60, let's say. This 142.40 to 60 on the euro yen, in my opinion, is an interesting one to watch. For one, if the Japanese continue to jawbone and the situation in Ukraine does not improve, it could mean that we hold there and we are going to retest the wedge level here in just below 140. Or if Japan remains completely silent and the situation in Ukraine does not deteriorate from here, we could be on our way again to why not 144.25 to 145 somewhere. So I viewed this 142.40-60 as a bit of a traffic islands in the euro yen. So that's one that I'm going to keep on my radar. Then I want to keep have a look at the euro dollar as well. Unfortunately, I've traded it really like a novice, like really. I've traded this one badly this morning. I sold it on the fixing on Friday, also because we went to test this 98.45.60 zone, and for some reason I cut it this morning while I was having a look at the euro cat, and I still don't know why I cut it really. Now we are back onto the first support zone here, 97.55.60 on the euro dollar. If this starts to hold here, this is all going to have been a month-end, quarter-end correction, and that's what it really is, unless the Ukraine situation improves, in my opinion. So I'll be still keeping an eye on this one to see if there's anything to do there. And I wouldn't be surprised if sooner or later we find ourselves back in this 96.60, 96.90 zone on the euro dollar. Not a lot has changed. As well, with looking at the fundamentals as well, if there is a bit of fiscal discord in Europe going on around this 200 billion euro spending program by the Germans, this could be an additional weight around euro's neck, especially that the Italians with their new government now are going to cry wolf about this, and some other countries who can't afford this kind of spending are already criticizing the Germans for having put that in place, or trying to put it in place unilaterally. So watch, keep a close eye on this 98, 45, 65 zone, in my opinion. And then above there, there's going to be some activity around 99.10 as well, if ever this goes on for this goes for a stop run. Cable. As the people know in our room, I've been trading it like a high frequency trading fund lately. It's whippy, it's fast, but with smaller positions, there is quite good money to be made on the if you're fast and keeping a close eye on the price action. To me, as long as we are, and we could even stretch it to 114, but to me, really here, this trend line around 113, figure 10, 15, this is where things are going to heat up. Whether it gaps there on another attempt or starts to break, this is going to be a pretty important level, in my opinion, with 114.10-ish above there. On the other hand, we've seen these moves into the fixings at the end of the month. They just ran above this resistance here around 112 figure to 112.15, and I think this is going to start to be important on closes if we get a close below and then start to get back under 111.50. I wouldn't be surprised that some people say, okay, this is not going to hold and we are going to retest levels sub 110 again. But let the market do its thing. It's the 1st of October, the 3rd of October, but the first day of the month. But I personally think it's going to be tough for the sterling with everything that's going on. Not only Truss and Kwarteng messing stuff up, but the spending, the tax cuts, all the others, they haven't seen anything put against it yet, where the government is going to get its money from. So that means more debt, more borrowing, and I think it's going to continue to weigh on the sterling. Quick look at what's happening in the metal sphere. There's a bit of a traffic here around 1660 on gold, but I'm watching this 1648, 1650, 48. I think some people are going to watch this as well. So this whole zone will need to hold, or it could be that we are back down towards those prior bigger levels. Top side, well, I mean, it's big enough. It's 80, 85, stretch it to 16, 80, 85, stretch it to 1690. It really needs to get back above there before we can talk about a bigger recovery, in my opinion, in gold. Silver is interesting. It's been holding it's been holding well through the whole end of month, end of quarter. Even saw a decent move back up. We do need to clear 1960. It's been a level before, so keep that in mind around 60, 65. Give and take a few cents because it's stuff that moves relatively fast. So watch it as a close, I would say, somewhere around this 1960, 65 zone. If we don't hold, if we start to close sub 1935.40, especially 1920 as well, we could have another test lower, but that is one that I'll be looking at adding to what I have if we see like bigger declines. Oils, well, it's all about OPEC this week again. If they cut output, there may be a push back up to 86.5. But then we have to look at what the numbers tell us. It's going to be important as well to watch the growth numbers for oil. If growth is holding up, this can recover. If OPEC decides to cut the output, if the global economies are faltering a little bit as the fear is now for recessions and the fear is growing, we could be in for another dump back to the 77s despite OPEC there. Brent a bit similar. Of course, the situation in Europe is a bit different, but we've got this similar situation. We need to break back above 90s, low 90s, to have a chance to get back into the high 90s. If it doesn't work and we start to get back sub those prior lows, I wouldn't rule out a move into the mid 70s before we start to creep back up into the real winter. And that brings us to Norwegian kroner. The euro NOK, we speedily ran up to 1067 at the end of last week. 1070 is a bit of a level here as well from July. To me, there's an issue with the NOK, because now, as we have seen, Norges Bank has increased their daily Norwegian kroner sales to 4.3 billion NOK a day, and that brings it in line with the high expectations of what Norwegian companies need to repatriate in Norwegian kroner for tax payments, and that was before we saw the dump in oil. So perhaps these numbers now are a little bit lower. There's a lot of hedging as well as that's been going on, and I'm just quoting what the Scandinavian banks have been saying over the weekend, and they expect more trouble for the Norwegian kroner into year end, because the Norges Bank has been killing the beast somewhat. So it's going to need, if we look at Brent on the other charts, it's going to need Brent to really ramp higher, European gas prices hold and go higher again, for the NOK to materially recover, in my opinion. So since I'm not a big bull on the euro, this one could potentially hold around 1070, but it's also possible that we start to run back up to 11, and why not revisit levels above 11 going into year end. But that's more of a medium term picture. This one in turn, if in line with what I personally am looking at, this one in turn, I'd love to see a retracement back down to 1060s in this one, because I think we are, after what I was just been saying and the expectations and what the Norges Bank is doing, I wouldn't be surprised that we find really beats if we get like some decent corrections here on the dollar Norway for a move back into the 11 territory. Why not go and have a retest of the 78.6 over time? Last one, we had for those following the emerging markets, we had the Rand manufacturing PMI coming out this morning, sharply dropping from above the 52 zone to 48. Dollar Rand is reacting to bad news now. I've also seen there might be problems again with Eskom in South Africa. There as well, I'd love to see a bit of a retracement, because I think Rand is not out of the woods, perhaps around 1780 or so, but of course, the dollar is a dollar, and the dollar can always turn around, because I know now, and I realize there's much more of two-way expectations for dollars, but in pairs like the emerging markets, the other side of the dollar pair is very important as well. So I'd love to see perhaps 1780 or really 1760 would be very interesting, I think, for the dollar Rand and worth a watch. And just the last one that I want to show, because I'm still in this one and I started to reload end of last week, we still can't get this Euromex. We still can't get even close to 90.90, let alone get back above 20. We know that Banxico has raised their interest rates up to 9.25% at the end of last week. that is very high. We know that they mimic the Fed, that there is a price for emerging market, that there is a risk on emerging markets when a global economy turns lower. But for the time being, and for as long as I don't see a material change in what's going on and real recession risk, I think this one, just based on carry, could resume at least at the start of the month, could resume its way down, and still it's a very nice carry, and I wouldn't rule out if we get a visit in the low 19s somewhere. Of course, if recession would strike and this starts to go back above now the 2040 zone that I've been highlighting for so many weeks, then I think there is something wrong, and then we could actually spike again. But as long as that's going to hold, I think this is still an interesting one to be on. And with that, Mr. Ryan, back to you.
Thank you very much, sir.
Oh, can I just show one more? I know I take a lot of time.
Blimey. Go on then.
Yeah, I know.
Yeah, on, mate.
A Eurocat 133.90, 134, monsterly important again. We spiked above on the end of month, end of quarter. We're now starting to gradually lose steam again. Look at this level. It's important in the short term. It's important in the more medium term. Keep an eye on Euro Canada 133.90 figure. There you go. I'm done.
Cheers, mate. Thank you very much. Yeah, I just wanted to go back to gold quickly. Slightly different numbers I've got to K. We're all round about the same ballpark. It's this. I'm calling it a 75-86 area, but I'm not going to argue over a few ticks with a big man. But technically, you know, sometimes there are levels that can be just technical perfection, and this is shaping up to be one of them. You can see how important this level's been all the way through around about that 75, and here we are on Friday, nudging up, testing the level. We had one go on Friday, had a second go on Friday, pretty much hit it on the nail, and now it's back down again. So it is worth keeping an eye on. My sort of pivot levels down at this 1641s. Yeah, you can draw this maybe a bit higher up towards the 90s. You know, these recent lows, and again that bounce there, you know, splitting hairs if you like. But in this zone here, if you're gonna want to look at shorts, that's the sort of area you want to start looking at. You know, you wouldn't put all your trade into perhaps that line now. Maybe if you're looking for shorts, scale it into this, but above 90, you know, you're likely wrong. And if it holds, then I suspect we get a further move to the downside. But I think it's all going to depend on what's happened, as Kay's mentioned, for month end, what the dollar's done. It's going to take at least today before we get maybe a clearer direction of where this wants to go. Or it could just do what it does at times and go sideways for a while. So that was my view there on gold. Now, I just want to highlight something as well before we end the show. We've got our Traders Summit out again, coming in October. A whole boatload of great guests coming again. For those who may not have seen this, we ran this show back in April. Had some wonderful guests, some real top headliners there. And we've got them again this year in 21st to 23rd of October. So it runs a Friday, over the weekend, the Sunday. So let me pop that link for you. Ooh, come out. Pop that link for you in there if you want to register. It's absolutely free to come and register for that. You can come and dip in, dip out as you like. It will give you all the speakers that we've got coming up there. We've got a great discussion on central bank policy between Peter Schiff and ex-MPC Bank of England man Danny Blanchflower. So that's going to be worth watching as well. But we've got a real good whole host of guys coming in there: Brent Donnelly, Michael Brown, Weston Nakamura, Joseph Wang, the Fed man, the ex-Fed guy. Some good names in there as well. So if you want to come and join that, then sign up now, grab your place for that in a couple of weeks' time. As I say, it's free, and yeah, you can secure your place there. And with that, I think we shall call it a day for today, unless there's any last minute questions on the chat.
Ryan?
Kay, did you cover Euro NOK?
Yeah, I did.
Dollar NOK? You did.
I did.
Yeah.
Just remind people perhaps of the FA ForexAnalytix prices.
Yeah. The FA prices are going up as well. So, you know, if you want to lock in, we've had a lot of people locking in. I don't know why they waited. They should have been in the room from the first place. Such is good our service. But if you want to come in there, you can lock in at the cheaper rate, and you can also get my sneaky discount, which is a 20% off. So if you apply that, and I've put that link in there as well, use code FF20 to get the discount there. Lock your prices in. Once they've gone up, these prices are unlikely to be seen again unless we hit deflation, and then we've got more stuff to worry about than subs. Thank you very much for coming to the Flow Show. Start of the week. It's going to be another manic week ahead, no doubt. We hope to guide you safely through it. Have a great day. Have a great week. Thank you, Kay. See you all bright and breezy tomorrow.
Thank you all. Have a good week.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.